Hi and welcome to Swissquote's Daily Market Talk. It's Monday, June 30th. The escalation of Middle East tensions combined with encouraging news from the trade front keep investor appetite in a sweet spot this Monday morning. But the US debt worries loom. The US dollar remains under pressure while the Swiss franc continues to appreciate, and that despite a broadly improved risk appetite in the global financial markets. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So last week brought investors to put more risk on the table as the Middle East tensions de-escalated with a US brokered peace between Israel and Iran, which is fragile but which seems to be holding well so far. Then the week also brought good news on the trade front. The US and China, remember, announced that they have reached a trade agreement on Friday that will help to restore the Chinese rare earth metals flow toward the United States in exchange of, some trade concessions from the US part. So VanEck's rare earth and strategic metals ETF jumped nearly 4% on Thursday last week and has consolidated gains a touch below its 200-day moving average last Friday. Then, Japan and India decided to extend their negotiators' stays in Washington, raising hopes that the negotiations between Japan and India and the US are going well and could lead to further good news in the coming days. Then, Canada actually took back a digital services tax on the US companies that it had imposed just last week to open the door for softer trade negotiations. And finally, Taiwan said that the country made constructive progress in the second round of trade talks with the US, and the EU's Ursula von der Leyen also sounded optimistic that the bloc will find a way to sign a deal to avoid 50% tariffs on the European exports toward the United States. I mean, all is well that ends well, right? As such, the S&P 500 advanced to a fresh record high on Friday's trading session. The Nasdaq 100 renewed record on its own, while the Dow Jones Industrial Index advanced to the highest level since March. Then the Russell 2000 index, which tanked nearly 30% after a November peak, has actually recovered more than 60% of the latest losses and is testing the 200-day moving average to the upside, while the US mid-cap stocks managed to break above their own 200-day moving average level and see improved momentum on the back of the softening yields in the US as the dovish Fed bets keep rising, and they keep rising despite the Fed's insistently cautious tone regarding the next rate cut, and the Fed Powell was repeating that the bank is not willing to rush into the interest rate cuts before having a clearer idea on where inflation in the US is headed amid the tariff uncertainty. But everything is well still. Nobody really cares. In Europe, the Stoxx 600 index closed last week on a positive note as well and above the 50 and 100-day moving averages, while the FTSE 100 index in Britain closed a touch below the 8800p mark. The Nikkei in Japan rallied past the 40,000 level last week on the back of trade optimism and kicked off this week on a positive note as well, while stocks in China and in Hong Kong are still not reacting too much to the encouraging trade news that we have on the wire, as both the CSI 300 and the Hang Seng Index see limited demand this Monday morning, and that despite the trade truce with the US and a set of better than expected PMI data. Although note that the manufacturing activity in China is in the contraction zone, so below the 50 level for the third consecutive reading. So China really needed this deal. But overall, the market mood is fine, mind you. Investors are actually pulling back their gold bets, but the Swiss franc remains surprisingly strong and in demand despite the risk-on mood in the market. The dollar franc just slipped below the 80 cents level last Friday, and the pair is consolidating below this level this morning, a level that has been breached only in rare occasions in the past, mind you. Once during the European debt crisis around 2011, which had forced the SNB to put in place a floor against the euro at 120, and the second time in January 2015 when the Swiss National Bank actually pulled back that 120 floor against the euro. So the fact that the Swiss franc's strength cannot be contained with zero rates, and when the news flow from the international markets resonate extremely well, is a growing concern for the Swiss National Bank that doesn't know what to do with the Swiss franc, and that is kind of stuck and hands-tied in this franc appreciation spiral that eventually hurts its exporters. And a currency intervention is not an option at this point in time when the trade negotiations with the US continue. The risk of pissing off the United States and Donald Trump that already put Switzerland on his list of currency manipulators in the past is just too high, and something that the SNB probably doesn't want to take. So I guess that the Swiss will have to take on the stronger franc for a while, at least while the trade negotiations with the US continue, and just try to enjoy their discounted summer vacations. But at some point in time, sooner rather than later, the Swiss franc's strength will have to be addressed by the Swiss National Bank to help the Swiss economy cope with the loss of competitiveness that comes with the stronger franc. The Swiss index has been dealing with the US tariff uncertainties and the strong franc since the beginning of this year, and the zero rates from the Swiss National Bank have done little to improve appetite, to say. So Switzerland really needs to address the strong franc problem, and we will see how they will do that. Elsewhere, the US dollar continues to weaken despite progress in trade negotiations. News that Donald Trump's beautiful tax bill is now headed to Senate, and if approved would add as much as 3.3 billion US dollars to the existing US debt pile. Actually continues to dent appetite in the US dollar and in US Treasury. So the US 10-year yield rebounded before touching the 420 level last week and is under a positive pressure this morning. There is increased incentive on the other hand from Europeans, for example, to repatriate their funds back to Europe and toward the euro-denominated assets, and the euro sees the benefits of the sustained appetite in the European assets. As such, the euro-dollar surpassed the 117 level last week, and the pair is consolidating gains above this level this morning, and that despite a set of higher than expected inflation figures that were released from France and Spain last Friday. And on the data front, more inflation data is due to come today from Germany and Italy, and tomorrow's aggregate inflation data for the Eurozone for June is expected to print a 2% figure that is slightly higher than 1.9% printed last month, but perfectly on the European Central Bank's inflation target, and will leave the ECB's options open for further support if needed. So that's positive and comforting for the euro and the euro-denominated assets. And other than the European inflation numbers and Trump's tax bill that he wants to pass before the July 4th holiday, the market's focus this week will be on the latest update for the US jobs data and a series of final PMI numbers across the globe. In the energy space, we will also be keeping a close eye on oil prices that have been given back the Middle East-led gains last week. The barrel of US crude is just sitting on the critical Fibonacci level near the $65 per barrel mark that distinguishes between the year-to-date negative trend in oil prices and a medium-term bullish consolidation. Expectation that OPEC will be announcing to bring more oil to the market at its July 6th meeting, that's this weekend, could eventually help the bears win the battle near the $65 per barrel level into the weekend and send oil prices lower. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.